All right. Welcome. Welcome. If you are joining us in the replay, welcome to this live stream. The goal here is to kind of reflect on recent real estate news, what's happening in this past week, have conversations, and, occasionally I'm going to bring on guests, my colleagues, people that I've worked with over the years and get their opinions as we kind of pull apart and dissect what's happening, in the real estate space. And for certain, if you're watching this video, you're probably either getting ready to buy a house, or you're in the process of buying a house, or you're thinking about it, and you have heard about the interest rate situation. And kind of like, it's kind of a freak show right now. It's all over the place. So I thought I'd bring in my trusted go-to guy in the world of mortgages, and a dear friend, John Harrington from Embrace Mortgage, have him kind of chime in on these things. And we're going to explore, kind of what the rates are kind of doing, like, in the past, what we think might happen, and how does that affect buyers, and how does that affect their pricing, their financing, and their purchase power, but also how does it affect the market? There's a lot of talk this week about if interest rates go up, it's going to have negative pressure on pricing because buyers will not be able to spend as much, so they're going to be pulling back on offers, which could change the demand, lessen demand, and then in turn, because of supply and demand, lessen the pricing. So we're going to kind of dive into those questions. So without further ado, John, welcome. Welcome. So excited to sit down, have a chat, grab a beverage, just water.
One of those.
For me.
Yeah, just water as well. Mine's in a cup though.
And to kick things off, like I kind of wanted to dive in, but first we're going to do something on the lighter side, like, of course, Super Bowl Sunday, which of course I think all of us here in Plymouth, if you live in the Plymouth South Shore area, we're also talking about the snowstorm that came out of nowhere and dumped like 8 inches of snow on us. But aside from that, we're talking about the Super Bowl ads, and in particular, this ad about the Rocket Mortgage Dream House. And if you haven't seen it, it's kind of silly, and take a chance. For those that haven't seen it, I'll include the link in below in the show notes there. But essentially, it talks about the fact that this Barbie is competing with all these different offers, and the Mr. Cash guy, and all this kind of stuff. And then Barbie comes in and so they've got financing with Rocket Mortgage, and poof. She's a winner because she got the Rocket Mortgage. Which, John, you and I both know that if there are multiple offers, and the cash guy's coming in strong, it's kind of hard to beat. You don't care what mortgage company you're going through. It's kind of hard to beat cash.
The old cash is king is still a statement that's pretty much true.
Absolutely. Unfortunately, yes, not always, right? Because, terms matter for certain. It's I always tell people it's price and terms always, and if you have strong terms, I've had situations where buyers have been accepted that actually had a little bit, that happened just recently, and the seller took a lower price, but we had stronger terms. So, all those things. But I just thought I'd bring that up because that was kind of silly, and I got a chuckle at it. And it's all the talk of Twitter. Like, it's all over Twitter. It's just a ruckus. Like, people got to talk about something, I guess, right? Like, if it's not that, it's politics or talking about celebrities or whatever. It's kind of silly. Well, let's dive right in.
Sure.
And talk about, first off, the I want to touch on the mortgage, what the mortgage rates are doing, and the interest rates, as far as what's happened this past week. And I want to start off by saying that I did a live stream last week, and this is how crazy the market is right now. I did a live stream last week, had a variable reliable source, and you probably backed this up, that they had predicted that by Q4 of this year, rates would top out at about 3.7. Right. That's what everybody was talking about.
Yeah.
And now I'm going to pull up that slide that I had actually talked with you about yesterday. And actually, it's updated for today from Mortgage News Daily. and we're at 4, gosh, 4.12%.
Yeah. Yeah. Yeah.
Blew that right out of the water.
Yeah. Yeah.
So what's your take on, like, what is happening? What can you talk, like, in terms of, like, why is all of a sudden this thing just, exploding, at such a quick pace? Why is that happening?
Okay, sure. First, I got to do a little housekeeping. Put my license number out there with Embrace Home Loans.
Oh, yes.
So mine's 756-150. So we're talking about rates and things like that. And
Yes, yes, we get it.
their license number is 2184.
Perfect.
Just so I have that out there. And I am with Embrace Home Loans, so I know we had the Rocket Mortgage thing out there, but I'm not associated with that.
Yes. No,
Embrace
see,
Home Loans.
we do everything above board here, John, right?
We're good.
Everything's above board.
Yeah. So, all right. So, our favorite topic of really for a long time, really, it's always seems to be a topic of no matter what they're doing, whether they're going up or they're down or whatever. So to answer your question, really a lot of this started maybe probably like 2 or 3 years ago, probably even before the pandemic. But I think the pandemic kind of held things back a little bit, actually. But really, what's happening is for years now, the government has actually been buying mortgage-backed security bonds. So instead of being on the free market, which they still are, the government was actually buying the heavy load of those to kind of keep the rates down. The more you sell, the lower the rates are.
Right.
The less you sell, the higher the rates go to get people in to buy them. And that's really kind of where all this is coming from. All right, first and foremost. So the government has had plans to slow back their purchasing of the bonds already. And we knew that probably last year sometime. I couldn't tell you exactly when. I apologize for that. But they're really like, yeah, next year's the year that we're going to taper back, as they say, taper back purchasing, which they've been slowing how much they are buying. But that's already things that we've already kind of noticed back in November. So things kind of started changing then. However, even at that, the verbiage was from the government that we're going to do it slowly. We're going to change the interest rates a little bit next year, maybe 2 or 3 times. So both those things combined are kind of what's forcing the rates up a little bit. So we've been expecting that, and really the end of this year from last year, we were expecting them to go up gradually throughout the year, but still have, probably the rates you were talking about that you mentioned, I think 3.75, right, was what they were talking about, that they would probably be that way probably throughout maybe the summer and the fall, probably have a little bit more adjustments when they raise the rates a little bit more, the interest rates that they control, and then kind of see more adjustments up to probably 4.125 and 4.25. We were really expecting that. Now what's happened is now, and we talked about this yesterday between ourselves, is that it's not really what they do, it's what they talk about they're going to do that the markets react to right away.
It's the rumor mill in live action.
Yeah, it's not what happens, it's what's going to happen or may happen. And this has been going on for a long time too with rates. So we've in the past have heard, this is going to happen. Rates kind of go a little different than they had been, or they've been calm and they kind of change out. But then that doesn't happen, and then the rates come back down a little bit. So they do react on what's kind of being fed out there for information, or shouldn't even really say information, but what they're putting out there for opinions from certain people in the government that, and as a matter of fact, right now what's happened is we have one person talking about changing, instead of doing 1/4 point in the next adjustment, which I think is going to be next month. They're talking about half. So even mentioning that or putting that out there is spooking the markets a little bit, because now instead of having it going gradually, now we're talking about a half right away instead of being at 2 meetings, which drags it out further. And it talks about changing it 7 times, 10 times. I think you had mentioned, somebody had talked about maybe doing it a little bit more than that or something. But all these things are coming out and they're being received by the market, who's can react to those quickly.
Right.
And that's what we're seeing now with that half mentioning about doing 50 basis points. That's a big difference.
Huge.
It's
Well,
huge difference, yes.
when I looked at this, literally, what's today? Tuesday, over the weekend, um, it was at 4.02 or something like that. Like, it was just over 4, and now
Mhm.
today it's at 4.12. Like, it's, it's you can definitely tell that it's being pushed up. It's reacting,
Yes. Yeah.
in that way. So, and it's a little bit crazy. And I guess, like, I don't want to ask you this question. I know that,
You want me to
if
put
you
my
had a
crystal
nickel
ball on?
if you had a nickel for every time somebody asked you the question, right? Like,
I wouldn't be on this call.
they put what is that? The Johnny Carson, like, put the
Oh
Schwammen
yeah.
hat or whatever, or whatever he used to do. Oh, try to
Right.
predict. Like, but in all seriousness,
Yeah.
I think that, yes, these rates have completely blown all the predictions. I mean, those
Yeah.
numbers that I talked about earlier, those aren't my numbers. Those
Right.
were, CoreLogic. Those were a combination of the Mass Bankers Association, National Association of Realtors, Freddie Mac, like all the majors. These chief economists that put this information out there. Um, that were just off base, because they weren't expecting this market could just take a life of its own. They weren't expecting that the
Right.
reaction would be this.
Yeah.
So the question would be is, okay, well, then that's great. And probably a lot of, homeowners, or people that are thinking, buyers that are thinking about getting into the market, or about to get in the market, or planning to do something this year. The big
Mhm.
question is going to be like, well, where does that, what realistically does that mean for the rest of 2022? Does that mean that they could continually get spooked and we could be looking at 10% interest rates at the end of the year? I don't think
Well,
so.
uh,
I
well,
don't I don't think
I hope not that
6%.
high, but
No, I mean, I'm not, this is not my area of expertise, but
yeah.
I don't
And
think we're gonna be touching 5.5% even. Like,
mm,
what do you think? I mean,
well,
in terms
and
of,
I
like,
think
what
we
makes
talked about
sense.
this. We talked about this yesterday in our you know pre-conversation about topics today. And the other part of what's happening with the rates is, and I mentioned that the government's tapering back on their purchases of bonds, but they're planning to stop. They have not stopped it yet. They're still kind of tapering down, but they plan on not buying any more at all, which will affect our market depending on what else happens. So just the interest rates alone may not affect us as much that they change their prime interest rate lending rates. However, what on our end, on the mortgage end, or on the mortgage bond end, is they're concerned about the balance sheet for the government and if they're looking to balance that. And what that means is not only they're not going to be purchasing those bonds any longer, they actually might be selling them off, which would actually flood more into the market of what, not only they're not buying any longer to put more on the market, they might be putting more out on the market, which would really affect our rates because now it's supply and demand. There's not that much demand because the government was the demand
Right.
recently. Um, but also they'll be putting some of what they purchased back into the bond market, which will kind of flood it out. So it's hard to say. I mean, I don't think 10%. I don't think they could, kind of go there. Uh, do I think there might be some more adjustments coming? Yeah, depending on what they do. If they do not clean off the balance sheet and they leave that alone, that piece of it, then we may not see, maybe not too bad. Like you were
Right.
talking about, maybe up to 5%, depending on how the markets react to the interest rates.
Right.
And unfortunately, I just read an article today, they're talking about the R word, which nobody likes to mention, like Baltimore,
Yes.
nobody wants to mention that word. Um, but
We're due, though. We're
oh,
kinda.
I know nobody likes to mention it though, but there's some indicators with the bond market actually that they might have inverted curves, and usually that's an indicator that that there might be some different things coming down the road. But you're right. I mean, it's it can always go up. I wish it could, but
Technically, though, we were, oh gosh, I'm trying to think of when it was. It was within the last 3 years, prior to COVID. Maybe it was 2019. We were technically in
Hmm.
a small recession,
Mhm.
right? Like all the stars aligned, all economic factors aligned. We were technically, but the housing market was untouched. And
Right.
and I know we talked about this yesterday too, about the fact that the supply and demand, the sellers, the extreme sellers market that we're in now, and looking at the numbers over the last 5 years, we had, as of this morning, 35 homes on the market. A healthy market I'm talking
Mhm.
Plymouth.
Mhm.
A balanced market would be around 350 homes, right?
Right.
350 homes would be a balanced market. If a perfect balanced market ever exists, which it never does, but
No.
but in a say this is Disneyland, it says
All right.
350 homes is a perfect market.
Yeah.
So we had back 5 years that would put us at 2018, right?
Mhm.
So
Yep.
2018,
Yeah.
we were at 190 homes, and actually 2017 we were at 185, I think, or vice versa. We were already in a
Mhm.
seller's market pre-COVID.
We were. Yes. That's
Right?
correct.
So
Yep.
so that demand, and because that demand was already in existence, supply and demand, the R word, it didn't touch the housing market.
Right.
Whereas in '08, the housing market started the recession.
Yeah. There
The
was a
mortgage market and the
different
housing market,
time. Yeah.
totally different.
Yeah.
Which is, I
It
think,
was a
is
different situation for sure.
yeah,
So I don't know if you want to touch
absolutely.
in on that, but I don't know if you do or not. But in those times, um, it was a different situation because there was a lot of different things going on with the mortgage market. Different things were happening. Some things were not. You know, they weren't looking. There was different programs available out there that they changed. Frank Dodd Act came around and put in
Yes.
rules and regulations for how we look at mortgages, what we have for programs, what we have for products, and how people qualify, clients qualify for that. Where last time there was a lot of things going on. I don't want to get into all those, but
It was the wild, wild west
yeah,
in
yeah, well, yeah, it
in a lot of
was.
ways, right? Like
Yeah, yeah. I mean,
I made the joke last week with Joyce that, people could walk in, buyers. I heard stories left and
mhm,
right with buyers walking in to mortgage offices, and doing a no doc loan,
mhm,
and the
yep,
mortgage officer say, "Okay, do you have a job?" "No, I'm self-employed." "Okay, so you don't have a W-2. How much money do you make?" 150,000. You telling me the truth?" "Yep." "Okay, you're approved for mortgage." And that's it.
yeah,
There's no verification,
right,
nothing.
right,
It completely, and then on top of that, they were getting adjustable rate mortgages. So
right,
not only were they unable to, really unable to support that mortgage to begin with, because
right,
they probably weren't making as much as money as they claimed they were making.
right,
Then they get the adjustable rate mortgages, which is something I definitely wanted to touch on tonight as well, and we will, in when we get to it in a little bit, in terms of like what how buyers can prepare themselves and what they can expect. But
yeah,
the lending environment now, right,
mhm.
is the adjustable rate mortgages. I don't know about you, but I hear adjustable rate, and it's like
Well,
PTSD almost. Like
yeah,
no, we're good.
yeah,
Like,
no, and actually,
gritty or fixed is the
I
way
do
to
want to
go.
touch in on that because you actually probably will see more arms as the rates go up. You'll see more adjustable rate mortgages. However, those were not the culprits back then. It was option arms, not the adjustable rate mortgages. There was a lot of adjustable rate mortgages, but they're not what you they're not what you think they are.
Okay.
Um, the option arms were different. You could actually pay less than you owed on principal in an option arm. There was a lot of those going around. That got a lot of people in trouble because they weren't making their principal payments, but adding the principal payments onto the loan itself. So, in other words, if you paid $500 less a month under principal, they would take that $500 and add that to the loan. So, not only are you not paying enough on the month, but you were adding $500 on your loan, and that
That's
was putting people. Well, that's what I mean. Those were available back then. Just to clarify, though, our adjustable rate mortgage, they're more structured than that. You do have a consistent payment for a couple of years, and then you also have caps on how much that interest rate can kind of increase throughout the loan itself. So yes, you can get a lower rate for few years. They have 3 years, 5 years, 7 years, 10 years. The 7 and 10 are really good programs because for the most part, folks are in on a house on average. How many years now?
Well, now
You might
it's
know
like
that better.
on average 8, 9 years. It used to be 5, 6 years. Now it's most definitely eight. Between
Yeah,
8 and 10 years is what the average is right now.
yeah, and that would be my guess, but that's what I've been hearing as well. So a 10-1 arm, you probably get a little bit better of a rate. It's fixed for 10 years, and then after the 10 years, it can adjust from there. And there's qualifications for it. You have to qualify, where the rate's going to end up, all those different things. So you might hear more. That's why I wanted to kind of explain it on this call.
Interesting.
Is that it's more structured. It's the option arms that really. So option and arm, people remember the arm part of that, but it was really the option part that was kind of dangerous. So you
Ah,
will see some more arms coming down the road as the rates kind of continue on, especially if you get into, I guess a rate here, but when you get into like over 5 and maybe 6, it's going to be probably a
well,
little bit more attractive if you can get a rate of 5.75 for 10 years fixed.
and I don't think, I mean, to be perfectly honest, like, I don't think that that's something uh, that we should be afraid of. I mean, I think that we've gotten spoiled,
Mhm.
right? We've gotten severely spoiled
Right.
that the rates have stayed so low for so long. I think a lot of buyers that either haven't been in the mortgage, haven't been in the market for the baby boomers that were in their house for 30 years, and now all of a sudden it's they're going to buy, sell, and maybe take out a small mortgage to get something else, or they're going to take a small mortgage to buy the second home before they sell the first, or the first time home buyers that all they've heard over the last 2, 3 years are these crazy low rates.
Right.
They have no idea that it's kind of absurd.
Yeah.
It's kind of absurd to the lowness of the rate. I go
Mm.
back to when my parents bought a house when we moved here. And I'll tell you, this is why I think that the rates go, we'll probably go into like the next question, which is, is
Mhm.
it going to push the buyers out of the market?
Yep.
And will it buyers decide not to buy? And the fact of the matter is like when we moved here in the early 80s, like the rates were in high double digits.
Right. Yeah, that's correct. Yeah.
They didn't say, "Oh, well, I know my dad was getting transferred here to Massachusetts. We're moving from I don't remember. We moved all over because my dad was a engineer on power plants, so we moved all over the country. And so we're moving in from out of the area, and dad was getting transferred. Buying or not buying was not an option. They were buying a house.
Hmm. Right.
They had 4 kids in tow.
Hmm.
Now they're not going into a rental. They're buying a house. They had a house. They sold it. They're getting into another house. So they paid whatever the rate was.
Right. And yeah, we talked about that yesterday. I mean, we've had rates where they've been in the low threes and there wasn't anybody buying a house. It was just the mindset that was out at the time. Um, a different situation. I think that we were in a bit of recession maybe, or, it comes down, well, actually, I'll take that back. It was more about unemployment, at that time.
Yes.
People were worried about having income or not having the income or maybe having to change in the employment they were at. So there's a lot of unknowns at that point. So even if the rates were at 3%, it was really kind of where they were in their lives, where they were in their employment. Whereas right now, I believe we're still at 4% unemployment. I don't want to quote that because I don't read that every day, but that's
Right.
what I heard maybe the other day actually, where you've got income and you've got a situation where owning a home is still the American dream. And when we had talked about it, it's really obtaining getting a mortgage is just how you actually means to obtain the home.
Right.
So it's the motivation of what your plan is with your life plan. It's a big life purchase, but if you're ready for that, you're ready for that. No matter what the rate is, that's really just the ends of the means on how to get there.
Right.
Yes, if the rates go up, your payment's going to go up because but you can't go back. To a month ago where maybe the rates were maybe at around 3% or 3.25%, where they're at 4.125. But you have to be prepared what the payment is because that's
Right.
really not going to change. But do you want to buy that house, for 450,000 and give yourself your dream? You also plan for your family, whatever it may be. And then, if rates kind of go down after that or whatever it may be, then, there's always refinances available, which we've done throughout,
Right.
the last few years where, they've kind of fluctuated up and down. And we've seen rates go up into the fours in the last 3 or 4 years. And people just don't remember that because they came down
That's
afterwards,
right. That's right.
and a little bit more consistent. And that's when the government was started buying more of the mortgage-backed securities to allow that to happen. I'm not sure if that's what's going to happen this go around. We'll have to see what happens with the balance sheet. But yeah, really, there's I believe you're agreeing with me that it's the American dream if you have the means to do so. And the other factor now, maybe where maybe a few years ago when maybe people weren't buying homes, um, even when the rates were 3%, is the rents are going up
Yes.
with everything else. So, I don't touch on those every day. It's not really what I do, but I hear, I hear, that different places, I know different places like, yeah, even here for like a 1 bedroom is like $1,800.
Oh, absolutely. And the reality of it is, and this is why I think that rates will not soften buyer demand.
No, and
Rates
I
will
totally
not
agree with that. Yeah.
soften the price. Rates are not going to be the reason why buyers there will be first-time home buyers that will be pushed out of the market. And unfortunately, and that's a very sad fact,
Yeah.
and
Yeah.
because it is an issue. I was actually reading an article earlier today that talked about the fact that affordable housing is a huge problem, and there's not enough affordable
Right.
housing. And I'm not talking like Section 8 housing,
Yep.
funded housing. I'm talking about just somebody who's a college student just out of college, starting out in life,
Right.
and they just don't have the means to get into a $500,000 home,
Right.
$400,000 home, and they just want to be able to get a piece of that American dream.
Right.
It used to be, I mean, I hate to say this, but like back in my day, like when I first got into real estate,
Yeah.
yes, it's relative, right? Like
Right.
because the cost
Yeah.
of living was different. So my condo that I bought for 80,000
Mhm.
was, those condos are 250,000 now.
Right.
However, I wasn't making the money that I'm making now versus,
Right.
back in the late 90s. Like,
Right.
you know what I'm saying? It's all relative. But if you look at the relativity and the affordability index, is getting strained. And I feel for first time home buyers because I believe in all my heart about, the everyone has a right to have housing, and everyone, if you work hard at your credit and you work hard to save, you should have options to buy, to buy a home. So
Right.
I think that unfortunately, there'll be some people that can't get their foot in the door, but you're
Right.
absolutely right. The way the rents are rising, and I actually had an article about that I grabbed earlier this week. See if I can find it because um, it was very interesting. Yeah, it was. Here it is. If I can pull it up here. Yeah, and it talks about, this is from NPR, literally yesterday, and it talks about the fact that like for example, this article, it talks about this professional. She has a PhD in entomology, and she is, she's making good money. She's working in Orlando. She cannot find a place of her own. She is, she said she had to, anything buying her. She had a waiting list of 6 months to find something, and she finally, moved in with another roommate because she couldn't find something. It's just crazy. It's absolutely crazy. So as rents are going up, you say, okay, well, $2,000 a month,
Mhm.
they should, that's what you're going to pay for, that's what you're potentially going to pay for a mortgage.
Well, yeah.
So it's
Yeah.
just,
Depending what your purchase price is, but yeah, to your point,
yeah,
yeah,
well,
you know,
exactly. And how much down payment and things
yeah,
like that. But,
yeah. We're
but
seeing more people going in towards the condo market uh, for
yes,
affordability. I'm getting some of the folks that were a little discouraged last year coming back and taking a look at condos at this point.
Which I think
Just
is
trying to get in the market,
a perfect. I am a big fan of condos as a starter place, as a stepping stone. I know a lot of buyers. I talk to, either they're just their circumstance, given their circumstances or whatnot, or they see what their parents have, and they're like, I just want my own place. Like, they're shooting for the moon, and they should. But at the same token, like the same note, like maybe you shoot for the moon, but maybe you like settle halfway in between. A condo is, yes, you have the condo fee, right?
Yep.
But it's manageable. You don't have to have the unexpected expense of how many, snow plowing and exterior maintenance and yard maintenance and, oftentimes, roof and siding and all that kind of stuff that the HOAs. So it's not like it's easier to budget, and you can get a 1,500, 1,200 square foot condo for the cost of a 700 square foot house. So I think it's a great way to go. So it's reassuring to hear from you that you're seeing more of that, more condo, lending and whatnot, because I think it's a really good way to go.
I think it was last year, I was like probably 20% of my business was condos.
Really?
Yeah. And I'm used to them. I've been doing them my entire career. So
yep.
I'm gonna plug in for my 25th year.
I think we got in the business same time then.
Yeah, probably.
When did you get in? 90, 96, 95?
25 years ago.
Okay. whatever that number. We're the same.
Well, I was working for a bank for a little while too. They're doing some stuff. So
what actually, so just to just kind of go down the rabbit hole a little bit with condos. So just for those watching, they're like, maybe like didn't even think about, maybe a condo didn't even think about buying a condo. Like maybe that's an option. So in terms of getting a loan, getting a mortgage on a condo, what types of options are there now? I mean, I know that back in the day, it used to be a little bit tougher because they looked at owner occupancy a little bit more strictly and so forth. So it was a little bit harder. Maybe the down payments were a little bit higher, whatnot. But, how is that for, I know there's FHA approved condos that, are a little bit easier, but if it's not FHA, are there options or, what kind of things, options do buyers have right now?
Okay. All right. Yeah. I'll be happy to answer that question. So I don't know if you're getting to FHA first or second.
What's that?
You want to get into
whatever
FHA
you want to
first
talk about. Yeah, whatever you. Yeah.
All right. Well, let's go with the conventional, because that'd be the easier way to go through. So, yeah, with condominiums, I always talk to my clients. Say there's two approval processes for condos. One is the approval process for your application and your purchasing, and then but part of that would be the approving the condominium. We have certain things that we have to take a look at for the condominium. So on their end of it, the application, it's actually treated the same way as it is for a home. So we can do them with as little as 3% down. And put in what the condo fees are, taxes, the insurance, principal and interest, mortgage insurance if it's less than 20% down. But the programs kind of allow for like you said, they used to be a little different back in the day, but now they allow for at least 3% down. Now on the flip side of that, the approval process for the condominium, we look for the docs for the condominium. So we look for the budget. We look for their bylaws that they have, just to make sure that they fit the guidelines for the condominium. However, if it's been an established condominium, like they've been around this area for a long time. So, and I know something's been around for 15, 20 years. I really don't worry too much about kind of their guidelines. They should be fitting those guidelines if they've been around that long. Sometimes it gets a little trickier if they have a lot of empty condominiums and nobody's been paying the fees. We take a look at that. But right now, the way things have been, a lot of these condominium projects are pretty full.
Yes.
And they're meeting the guidelines with reserves. They're meeting the budgets. So at this point, they're not too bad.
So for seasoned condominium complexes, so are you referring to just FHA approved
No, I'm
condominiums?
sorry.
Or so if they're not FHA approved, there's a little bit more leniency as long as they're kind of a seasoned condo association. Like I can think of a couple right off the top of my head in Plymouth that aren't there, maybe were FHA approved that are not, or some that are
Right.
just not, but they're, well managed. They have reserves and whatnot, but just maybe they
Right.
haven't been, for one reason or another, they didn't go through the FHA process, or maybe the owner occupancy is not as high. So,
Yes.
has that been relaxed a little bit in terms of
Yes.
the,
So on
okay,
that end of it, the owner occupancy, which I want to touch on real quick, as long as they're buying it as a primary residence, they don't have a ratio for that.
that's awesome.
Yeah.
And
So if they're doing it a second home or an investment property, then they look at the ratios. However, if it's their primary residence, they do not look at that ratio.
so just to clarify for those watching, so the um, owner occupancy ratio. So that's something that typically what the mortgage companies will look at
Mhm.
is how many people are living there as a primary residence, how many renters, and if
Mhm.
the renters exceed a certain percentage
Yep.
of the total amount of units in the building, um, in past history, they would deny the loan based strictly on how many renters.
Correct.
But what John is saying is that's kind of that's been loosened, which is awesome because
Yeah.
there's a couple condominium complexes that are
Right.
maybe a better value because there's more tenants, but you can
Correct.
still have that opportunity to get your foot in the door in something. And I think that
Right.
getting your foot in the door to build equity, no matter
Right.
how you can do it, is the name of the game right now, right? It's
Right.
the name of the game.
Yeah, so
So
that's true and conventional. Now, so that's kind of what we do. We take a look at all the information from the condominium. We make sure it matches the guideline for conventional, and we put the two together, and that's your full approval for closing, is both parts. Now, FHA is a little bit different. So we're talking about the owner occupancy. FHA is requiring 50% owner
wow.
occupancy. So they're
Yep.
they're still staying to like what they had originally. They have not changed that. And they require approval from FHA on condominiums. I think you're aware of those. So they do have their own approved list. If they've gone through that process. Now, a lot of places are not going through that process, as you mentioned. It is a bit of a process to go through. It's a lot of paperwork that the
Right.
association has to gather. We, in turn, would send it into FHA, who then takes a look at it, make sure it's approvable, and then they do the process and approve the whole complex. Once that's approved, to your point, if they're on that list, it lasts 2 years now. They do have an expiration once they've approved it. After the 2 years, they would have to re-up it. But if they're already on that list currently, then it is an easier process where we just kind of have to just do a couple check marks for FHA to make sure they're still in standing for a few different things.
Right.
But as long as those things are all set, then that approval is all set. We don't have to go through the whole thing going to FHA. Now, I'm going to put a plug in for myself in Embrace. Sorry. We actually have a process where FHA is sanctioned us to allow us to approve a single unit if they fit the guidelines.
Really?
Yeah. So what that means is instead of
Interesting.
us sending all the information into FHA, we actually could do it in-house, and they've sanctioned us, allowed us to do that. I just did one a couple of months ago, which worked out great. It's a
Interesting.
nice young lady buyer. She had to be FHA, but it came together. The seller, I think, knew this person or whatever, but the only way she could go was FHA. So I said, listen, we can do this. Let's do that. Got everything together, and it was approved. But it's quicker than having to send it to FHA. That could take
Yeah.
month and a half, and then they
Yeah.
might want more
Too long.
information.
And a lot of
Here,
sellers won't sit around and wait for that to
yeah,
happen. If you're
here I
competing
got
against
somebody
another
on
offer,
my end that looks at it right away, says, "Hey, John, we need this." Or we don't need that. We got good. Then they take a review. It takes them a couple of days to kind of make sure it's okay. But even if we need something, I know it quicker than doing it the other way around. So it's a nice process to have. I guess
and
a little
just
plug for us.
no, that's really actually that's a great that's a good takeaway for me. Um,
Well,
and
there you
just
go.
so for people watching, the difference between an FHA versus conventional. Obviously, conventional sounds more appealing, but just why would somebody go for one or the other? Is it basically just credit score, qualifications that why someone would be put in this pool versus this pool? Is that what the determining factor is typically?
It is, yes. So if I'm talking when I'm talking to a client, really my job is to match them up to the best program that's going to fit their situation and the scenario. And what I mean by that is credit, down payment, debt to income ratio, which the three things we look at mainly at first, anyway. So FHA would be either credit, the debt to income ratio, or the down payment. They may not fit into the 3% down payment, but if they have minimal at 3.5%, which is FHA, then we look at that program for them as well. It's so conventional is definitely the better if you fit into their guidelines, but if you don't, then we're looking at FHA to be the solution, or get your mortgage, which is really the key part of that. But FHA just has some different things that are different than a conventional loan is.
A little bit more forgivable.
Yeah, it has to do
Forgiving,
mostly
rather.
with the mortgage insurance, but they are more forgivable with credit and with debt to income ratio. So, it's a conversation they have with clients, and they've had some past say, I've got to be able to buy this house, at 450, but conventionally you qualify at 400, but in FHA you qualify at 450. You're going to have to take this route to get in there.
Right.
I know, and then down the road, we'll take a look and see if we can refinance you into like something that may be a better situation with the mortgage insurance. But that's
Right.
usually that's a bigger key thing with that. The mortgage insurance stays with the life of loan on FHA. So if you're in that loan for 30 years, you're going to have the mortgage insurance for 30 years. Whereas conventional, if you get equity in the property down the road, usually the max number is 20% or 22%, depending on what you're doing. That they can remove that mortgage insurance payment off of the mortgage statement. That's the bigger between the two. I know we weren't going to touch in on that, but I guess we did.
No, it's
Um,
this is a free-forming free
yeah,
flowing
but I mean
conversation, so that's good.
it's good. Yeah, but that's the difference between the two, and that's what I look at for clients. There's no incentive for me to put them in FHA, no incentive for me to put them in conventional, except for I just try to put them in the best situation
For
for their
them.
scenario, and everybody's different because they all rely on credit scores to qualify. They all rely on debt to income ratio, your down payment, and there's a couple of different other factors in there, but I want to touch on those. So, do we
Yeah.
want to morph into maybe some, that we're talking about it? I guess maybe morph into
Well, I thought
options or
I wanted to jump into kind of down payment stuff because
Mhm.
it's kind of
Perfect.
segue into what we're talking about because
Okay.
as interest rates are coming up,
Mhm.
right? It's making qualifying a little bit harder, and it's already tough in terms of the market and the demand on the market and people having to come up with that down payment. The more down payment, like I was talking about earlier, like if you have a buyer that makes an offer that they're doing a 3% down, and another buyer that's making an offer that's doing 10% down, that puts you in a more favorable position for the seller. And so there's this need for down payment. But now with the interest rates going up, oftentimes you say, well, geez, you know what? We've got to try to offset that. So maybe putting a little bit more down payment to offset a little bit of an increase in payment, this kind of thing to try to offset it.
Right.
And I had posted a reel on Instagram a couple days ago, and I did a short reel about just in terms of the payment and how the interest rates may affect the payment, but it's not going to be relevant in terms of the decision to buy.
Mhm.
Buyers are ready
Right.
if they're ready to move up because of their financials or because of their home situation,
Mhm.
maybe their financial situation, maybe they worked hard and they got the FICO score up and, so on and so forth, and they're finally ready to buy. That is not going to be affected because the rates start to tick up. But the question came up from someone that posted, a friend of mine posted, and she said, okay, great. I can afford the payment. If I have a friend that can afford a payment,
Mhm.
but doesn't have a down payment.
Right.
And so that is has been for years. It's been a hardship. But there was an interesting article I'll pull up real quick here
Okay.
that talked about, let's see if I can pull it up here, about the Gen Z and millennials being the largest market segment, as they come of age. And actually this market, talked about that in terms of, this article talked about that in terms of, these, the tail end or the beginning of the Gen Z, but really it's more the millennials. They're coming of age. That market segment is bigger than the baby boomers and Gen X combined.
Right.
And these kids are ready to buy. They're
Right.
out in the marketplace, and the pandemic has really kind of taken a bite out of their savings, and this article talks about, during the pandemic, millennials range 26 to 41, members of Gen Z, according to a new bank rate survey released last Wednesday. They surveyed more than 1,000 U.S. adults, and the millennials are also more likely to use more likely than other age groups to owe more credit card debt than what's in their savings, which is very an interesting dynamic, given that they watched their parents go through the recession of 06, 07, 08, right? And what that debt kind of did to them.
Right.
And so it was just an interesting, it says, before the pandemic, millennials actually tended to save more, which was kind of the trend,
Right.
And then it goes on to say, but periods of income disruption and outright unemployment, can quickly erode what savings have been built up and result in credit card debt that didn't previously exist. So, so now you've got these kids that, want to buy kids. The kids compared to me. It feels like yesterday they were my peers, but now they're kids.
I think you're okay with that, but we'll go with young people.
Right, young people, but
younger people, I guess.
Yeah, and I'm thrilled that they're seeing the value of home ownership. I'm super happy. I'm super happy that they see the value of owning a home as opposed to just going straight into rentals. I've seen a lot of people, a lot of clients who go directly from living at mom and dad's house, skipping right over the rental part and going right into a home, which I think is great. But, I wanted to ask you in terms of, down payment, and we talked about what the down payment requirements are, but, I think that, well, I'll start off by saying that, in terms of down payment, the one thing I will say about this generation is different than the baby boomer generation. Is the baby boomers saved, and they would forego extras to put that extra $10 in savings, $20 in savings, $30 in savings every week, whatever it took at that time, to get the end goal, and that in this generation, this gotta have it now, this instant gratification society that we're living in, that's going by the wayside. I think for certain there are people. I save. I knew my daughter Caitlin was going to need a car for college, so I started saving like 4 years prior, every month, little bit, so that, okay, great, when time was right, wrote a check. And it was it was in that amount. I wouldn't have been able to just I could have, but it would have been a stretch to just say, okay, just come up with that, like that. It would have, maybe dipped into savings or whatever. So I think there are certainly people that do that. But I think the younger generation, not to pigeonhole them and say that they're all like that, because I know a lot of them are not, but I think that part of coming up with that is just good old fashioned budgeting and being patient. Right? Like, good things come to those who wait, which stinks in the sense that, yes, interest rates will be higher. Yes, values will be higher, but that's one way. But outside of the traditional way of budgeting and saving and whatnot, what other things are you seeing? Anything out of the ordinary, anything new or different, or what do you see as the trend in terms of people coming up with, down payments, other than that, other than just saving?
Okay, well, I'll give you a few options, but first, just a lot of we talked about this just too. I've been doing this a long time, as we mentioned. Still, there's still thoughts out there that you need 20% to buy a property.
I know.
20% down. Well, I should say there's some properties you do have to, But if you're buying a single family home or condominium, the 20% is really right now, that's kind of where the threshold is to avoid mortgage insurance.
Right.
So if you're putting 20% down or more, you're not going to have the mortgage insurance. You still have to qualify for a mortgage, etc. So some people still have that in their head. It's 20% down. However, we mentioned before, there's really a couple of different benchmarks that we have less than 20% down, but those would result in mortgage insurance, which is okay. It's just a payment like any other insurance. So you can do as little as 3% down. In some instances, no money down. We've got the veterans loan, which is no money down, actually as an option for veterans or current military or Coast Guard or National Guard, actually, depending on how long you've actually served with those National Guard or Coast Guard. But they have a zero down option for
I'm
anybody
glad you brought that up.
military. And I do, because I want to mention all of them. And then we mentioned, I think before, about a USDA loan, which can actually be no money down. Other than that, the benchmarks are 3%, and there's some income qualifications with that 3% and some credit. So not everybody's going to fit in that, and some require to be a first-time home buyer. But after that, though, the 3.5, 5, 10, 15, and 20, it's all conventional. There really aren't any income guidelines for those at all. Just the 3% and the no money downs. We'd be looking at income guidelines and credit that you have to fit into their guidelines for those. The other ones are a little bit more flexible. So that being said, though, all right. So there's different ways. All right. So there's saving. You save the 3%, you save the 5%, and we had talked about that. The average price of a home now for first-time home buyer is
400.
300. All right,
About 400. It's right now. I think the median price. Well, the median price in Plymouth has gone crazy, but
yeah.
It was around 300. The average home buyer price, is anywhere between 350 to 450.
Yeah, 350, 400. So yeah, I mean, you're talking 3% of that is going to be about $12,000. That's minimum. You go up the ladder from there. The 20% at 400 is $80,000, and I think we had talked about that yesterday. That's a lot of savings.
That's a long time.
That's an 80. Yeah, it is. I mean, even if you got two incomes coming in, you already have your expenses now. Putting things on top of that, and on top of that is it's going to be a challenge. I mean, some people probably can. You don't have to wait for that. Yeah. So we may have options for you, depending on what you fit on those qualifications. So with $12,000 sounds a lot better than $80,000 for sure.
Right.
12,000 is more manageable, and we do have programs for that. Now, that doesn't have to be. Well, it can't be cash. Number one, but it's another story. I've run into that a lot lately. But if your typical checking in savings account savings, sure, that's fine. But what some people don't realize, and I'm going to talk about gifts last, but 401ks. Now, if you've been working for a little while and your 401ks have been increasing, and with the market way it's been the last couple of years, you can actually, a lot of plans, and I do mean a lot, you have to check with your particular plan what they allow for, but they can either allow to actually withdraw the funds from your 401k that you would need. They want some information for that. They want information from me on what the closing costs would be, and they would want to purchase a contract to make sure that's what you're doing.
Right.
Withdraw the funds, but they will allow for that. Or you can actually do a loan against your 401k. And what the loan means is that you're actually borrowing off yourself, and you're going to pay yourself back over like you would another loan, but you're paying yourself back.
Right.
So you're not borrowing it off a bank or whatever else. You're actually borrowing it off the savings you already made, and you pay yourself back over time through your 401k. So it's a pretty good option, especially the loan. I've had people, it depends on what their situation is, they'll do one or the other, but it is an option. We do allow for that. And if you do the loan, it doesn't account against you. At one point, it would have. They changed that where they realize you're paying yourself back, so they're not taking that payment and putting it towards your debt to income ratio. And at one point, they did.
A lot of people, and I'm glad you brought that up, because I have found over the last few years, as this has become more of a hot topic, that a lot of people don't realize that money that they're putting away, that the money gets automatically deducted out of their paycheck every week for that 401k. I mean, it's their money, but and for going to buy a car, you can't take the money out
Right.
without a penalty to go buy a car. But a home purchase, 9 times out of 10, that's a penalty-free withdrawal. To your point, you have to give some sort of a purchase and sale,
Hmm.
which, I mean, you'll know if you talk to your HR department before you start the process, they'll be able to confirm, yes, you can take it out. And then you know how much is in there. And the HR will say, okay, you can take out up to 80% or 90% or whatever that number is. And you just look at the amount that you have and you can figure out how much is in there so that you can go forward and say, okay, well, I know the money's coming.
Hmm.
And then, okay,
Right.
now it's time to start the wheels turning. You can take the money out. But, and, I think that that money is, yes, it's for certain important to be there for retirement. Um, but you're building wealth in your real estate.
Right.
So yes, you're taking it out of your 401k. I can guarantee, especially right now, you're going to make more money in that real estate you buy than the interest you're gaining on your 401k.
It could be, and that's why I like the loan option. I don't really steer anybody anyway. When I talk to them, I just want to make sure that they do check with their HR to make sure what they can do. And usually the loans, they can go higher than they would if they did a withdrawal as well, because it is a loan. They do have to pay it back. If they don't pay it back in a certain amount of time, they will get taxed on it. I don't know what that time frame is. I think it's different for all of them. But however, I mean, they are paying themselves back. So they're really borrowing the money from themselves and
Right.
paying themselves back. So if they withdrew it, like you said, now it's gone. But if they take a loan out, now they're paying themselves back. That money goes back into their 401k.
Now, does that loan count negatively against them qualifying for a mortgage? Like,
No,
does that?
no, that's what I mean.
No.
That's changed. At one point it did, and we'd have to use that payment as it would for a car payment or credit card payment. But now they've changed the ruling on that, where they know they're paying themselves back. So they do not they don't use that in the qualification.
Awesome.
Yeah, so it doesn't
Awesome.
hurt them for qualifying. That's why I like that option. But like I said, I just try to inform people. I don't make choices for them.
Well, and to, like you said before, it's, you're taking advantage of this, very productive stock market,
Mhm.
and these 401ks have grown. So now, time to cash in. Um, touch on gifts. Have you
Yep.
seen a lot more gifts? I mean, I've seen on my end, it seems like, we've got the baby boomer market is so huge, and these baby boomers very often have been in their home for, you know, close to 30 years, a lot of them, and have no mortgage payment. They're sitting on cash.
Right.
It's one of
Right.
the reasons why we're seeing so many cash offers these days. There's a ton of money out there. There's a
Right.
ton of money.
Right.
And, what I've seen a lot of is that they've taken that money out and helped their child as a gift, from their equity, helped a child with a down payment, $10,000, $15,000 or whatnot. That's for certain an option, right? Are there any like penalties or like anything that like if somebody, a family member wanted to help you out, or say, okay, we're going to give it to you and then pay me back whenever you can, kind of thing.
Well,
Or
I can't hear that end of it.
well, that's true because then it does count, right? Like if there's a loan, I guess that's important to
They
talk
can't even
about.
do that. Actually, it has to be a
Oh,
gift. Yeah, they have to.
that's
There's
right.
okay. So I'm sorry. I'll segue it. So yeah, there's actually the process is we do check where it comes from. We check the deposit, and then there's a contract really that they have to sign that it is a gift.
Got it.
Yeah. So it certainly has to be signed and agreed upon that it's going to be a gift, and it doesn't have to be paid back.
Perfect. So if you've
I,
got
I
some
could I
like
could wink on that, but I've got nothing to do with that.
so
But
if
yeah.
so if they've got some like rich relatives
Mhm.
that they haven't talked to in a while, it's time to pick up the phone.
Yeah, it has to be a relative. That's a good point. In some circumstances, we might be able to stretch a little bit if they can show a strong relationship with the person that's gifting you the money. Then we can kind of go there. But to answer your question, I've actually seen gifts throughout my career. I don't really think there's been more of them lately because I do deal with a lot of first-time home buyers, and I let them know what the options are. I certainly always let them know that that could be an option for a down payment. It's just we have to kind of follow. I always say follow the bouncing balls. We have to kind of
Right.
go the gift back and check with those things. But once I kind of explain what they can do for that, what we need for that. However, what has changed from maybe it's changed a while ago, where on conventional loans, you used to have to put 5% of your own funds into a conventional loan before that you could do a gift, whereas now you can actually do it all gift.
Really?
So if you're putting 5% down on a conventional loan or the 3% down that I mentioned, it can be all gift.
That's good to know.
Yeah,
That's good to know.
It can be all gift to closing costs, whatever they need. It can be a gift, as long as it's from a family member. So like I said, we have to kind of follow that. But it is something that's allowable on all programs at this point in time. Yeah.
So I'm gonna do my my speech that I always tell I always talk to my first time home buyers about, and that is the budget speech and the importance of reserves. And what I would say is that when I sit down with a first time home buyer, particularly because I mean, if a move up buyer will have equity and they can tap into that, you don't have to. When you sell your house, you don't have to roll all that equity into the new house. If you have $100,000 equity, they can take 80,000, put it in the new house, take 20,000 and pay off credit card debt or put it in the bank or whatever. But it's super important. And I always am asking my first time home buyers, what their cash situation is. If you have hardly any money in the bank, you have $1,500, $2,000, if you're lucky, in the bank, and Aunt Sally is going to give you $15,000. Do not take that whole $15,000 and use it for your down payment. The worst thing that could happen, you always have to assume that something is going to break something. There's always going to be a buffer. I think that that's important as to, in terms of protecting yourself. And I think it's always good practice anyways. I read an article this week that said that because of spending and largely because of COVID, because it ate into, people's savings accounts. People are unemployed and things, people, credit card debt in general, not just millennials, but credit card debt in general has gone up. And the fact that we're not saving, they said about, 1 in 7 homeowners has over $10,000 in savings or something like that. I mean, I wish I had kept the article. Actually, it was extremely low, which means every time something breaks, you move in. Now you have I tell my buyers, you have a home inspection. The home inspection is there to inspect the house in its current condition. You could move in, and the week after you move in, the furnace dies. There's no way to determine when the furnace is going to die. The hot water heater is going to die. Something's going to go on the fritz, your stove, congs, whatever. You don't know. So how do you pay for that? You start racking up credit card debt because you don't have the reserves, which is what a lot of people do. And, I would just use the caution. And when someone says to me, I'm getting X amount of dollars. I have a client that I've had this conversation with actually just recently. And she says, I'm getting a gift. I says, you know what? You have enough for the down payment. That extra money is not going to kick you up above to the 20% mark. It's not going to significantly. So every $10,000, right? Every $10,000 is right now about $40 a month, right?
Yeah, about that. Yeah.
Okay.
Yeah.
So it does not significantly change your monthly mortgage payment. It's way more valuable once you get to that point of having enough to get your foot in the door. Take that money. Would you agree? Like, take that money and put it in a savings account.
We both have the same kind of conversation. So I do let people know, once you hit that benchmark of 3%, 5%, 10%, it doesn't really change your situation with us. Some things do change from the 3 to the 5 to the 10 and the 20. But once you hit that 3 or 5 or 3.5, it doesn't, like you said, I let them know, yeah, you can wait for $10,000, but it's like a $40 a month difference in your payment. Or you might be better off having that for situations like you were talking about. Or you want to buy new furniture, or, all these different things that are going to come up after you're in the property. You might be better suited to have that $10,000 in your savings.
Much easier to come up with. If all of a sudden something happens, it's much easier to come up with $40 a month than it is for $10,000.
Yeah, and people are shocked that $10,000 is only it depends on where the rates are, but at one point it was $30, and now it's 40. It might be 50. But to your
Right.
point, it's easy to or even if you have that money in your savings, you can make up that $50 difference with the savings that you have
And
put
you could
aside
and you can
if needed.
always take that money, like, so say tax time comes, one of the things that I would say probably 9 out of 10 of my first time home buyers don't realize this, but the tax deduction savings when you file your taxes after that first full year, all of that interest, the interest deduction, comes back to you, and all of a sudden now you've got another two, three, $4,000 in your tax return because of making your payments for 12 months. You could easily, if you wanted to, if all of a sudden you had this landfall of money, you have that extra $10,000. You're like, you know what? I'm comfortable. I have a buffer. I can take that. You can always just take it and do a principal only payment. You could do, what's the minimum that you have to do a reamortization? Is there a minimum, to do a reamort? Because usually there's
Yeah,
like a
that's well,
small
that's
fee.
different. Yeah, that's a different. Yeah, it's a small fee for that. Yeah, it's a
Yeah,
different
and then they just
situation.
readjust your loan. They don't rewrite the loan because you still stay within whatever terms, everything else, but they just adjust the payments so that now your payment is, instead of $2,000 a month, it's, 1950 or whatever, or 1800 or whatever. They readjust based on your new principal. It's an
Right.
option, is what I'm
That's
saying,
right. That is
right?
an
It's an
option. Yeah, that's
option.
correct. Yeah, that they can do that. However, I think the other, to your point, if they're making that extra payment without re-amortizing everything, because it's different than just doing a couple of thousand. But if you do one extra payment per year, like you're talking about, you get your tax return back, that 30-year now really goes down to about maybe 22, 23 if you do it every year for the
Yes.
next 23 years. You don't see that savings immediately like you're talking about, but you certainly are not paying the interest on the principal that you're paying down, and it comes off of the years towards the end of the mortgage itself. So I'll let people know that, and usually attorneys let people know that too at the closing, just to kind of give them a heads up. Because
Yeah, and
everybody has
it's
different plans, So and when folks are talking to me about differences, because you kind of have different time frames. We talked a little bit about the ARMs, but and there's also 10-year fixed mortgages, 15-year fixed mortgages, 20, 25, and
yep,
30 years. They're not all 30 years. You
correct.
can have whatever one you really like. However, if people are kind of cautious, which they should be, you never know what's going to come down the road, is that if you take a 30-year, you have more control over what you pay per month
Yes.
if you want to pay extra. So if you take a 20-year mortgage or a 15-year mortgage, you have to make that payment for the
Right.
next 15 years. And
Right.
if you get run into hard times, hopefully you don't have that situation where it's going to be a problem. But if you take a 30 and make extra payments, chop it down to a 23, you have control of that. So if you have a
Yeah.
bad month, just make your 30-year payment. You
Just
don't
make your
have to make a
30-year.
20-year payment.
I'm with you. I mean, being self-employed, I definitely
Mhm.
tend to be on the more cautious side. Just even though, I try to do the reserves and try to make smart financial decisions, like during COVID, who knows, if I
Right.
think, thankfully, knock on wood here, I didn't get sick. And but what
Right.
if I did and
Yeah.
I couldn't work?
Yeah.
It's like
Yeah.
I want the lowest payment possible. But in the meantime, I always say, the power of compound interest, the power of compound savings. It's just amazing, that if I'm a big fan of automatic withdrawals, not automatic payments,
Mhm.
but automatic withdrawals. So, every week I have a certain amount gets taken out of my checking account, goes directly in my savings account. No control over it. I mean, I could stop it if I wanted to,
Right. Right.
but it's
Yeah.
automatic, and
Right.
if you
Yeah.
do
No, think
that,
about it.
you
Yeah.
don't realize it, you don't miss it because it just automatically happens, and oftentimes I'll be balancing my checkbook, I'll be like, "Wow, I have more in my savings than I thought," and then I'm like, "Oh, right, because it automatically did the withdrawal, whatever," and you could certainly do that for this, you could do this for, you could do that for the down payment, you could do that for
Mhm.
monthly mortgage payment, and just automatically take that money out. You don't even realize it. That doesn't have to be, because it's harder to say, okay, well, this the newest gadget is out, and I have to say no to it. But if the money's not there to begin with,
Yeah.
it's a little easier to say no. I think anyways. Like, I could be wrong. I don't know. This is the inner
That's another.
workings
I
of
think that's
Jen.
another topic for another day.
Yep, this is the inner workings of Jen. So I think the bottom line here, I guess the only other thing that I kind of wanted to just touch on,
Mhm.
that I kind of alluded to at the beginning, which kind of ties into this whole conversation, is just, the impact of all of this, on prices, right? And home values and
Mhm.
whatnot. And, given, the nature of the impact of what we talked about with interest rates, and
Yeah.
how little impact it's going to have in terms of buyers, in the big picture.
Mhm.
The impact, the marginal impact that it's going to have in terms of buyers that are in process, buyers that are planning to buy. I will tell you, to be honest, the first conversation I have with anyone, any buyer, particularly ones that are moving up, the first conversation, there's nothing about interest rates. It
Right.
doesn't even come up in
Yeah.
conversation.
Right.
As it should.
Right.
It's not something that is influential in their decision. So it's not going to affect that. It might affect some first-time home buyers, but the
Mhm.
majority of buyers that, if home buyers are coming in, they have down payment money, they're just going to adjust their price. So, in terms of what they spend. So I think at the end of the day, not I think, I know, based on the demand that's already there, the demand that's going to come with all these millennials continually coming into the market, on
Yeah.
top of all the buyers. I had a call from a buyer the other day that said, okay, we've been in our condo for a few years. We've added to our family.
Right. Yeah.
It's time to go.
Yeah. Right. Yeah.
Though that kind of story is going to continue to happen. So
Yeah.
if the buyer pool doesn't change
Mhm.
and the demand is still there,
Mhm.
and the real estate market, the inventory is not going to change overnight. Like, it's just we hope that there'll be more listings. There'll be more listings coming, and I've watched the meter, change
Yeah.
daily. I get
There
all
might be some
excited.
other things coming through as well.
There might be,
You
I
know.
think that there'll be some, as the forbearance ends, there'll be some foreclosures
Yeah.
coming,
There's
or
some stuff
people
coming down the pipe. Yeah.
coming, selling their home that might have been foreclosed, I should say, because, I think a lot of people
Yeah.
will avoid
And
the
some it
foreclosure
might
process
have to, and get out with the equity before something does happen.
before
So
something does
yeah, there's
happen,
going to be some things unfortunately coming through probably in the next year or so.
which
In
will
those
help.
outside things, besides folks listing their, but we'll see how that impacts the inventory. However, like you were saying earlier, I mean, the inventory is just so far off. Even with these outside influences, it's just not going to make up that difference to get a balanced market. I don't think in the short term, for
No,
sure,
which
because it's people are buying houses, so
right.
it's demand that's really pushing it.
So you have supply issues, high demand, and when you have that scenario, that is not downward pressure on pricing.
Yeah, and
It's not. The prices are, and I think that's the kind of, the conversation, kind of what people are wondering, is the interest rates going to, and kind of the premise of this conversation is, are the interest rates going to be, are they going to, is there going to be downward pressure on the values because of interest rates? And the answer is no, asterisk. And the
well,
asterisk
yeah,
is,
yeah,
the question is how much. So I know Zillow had, there was an article that I'll pull up real quick, that, let's see if I can find it, that they did, last week, about home pricing. Like, they revised their home price estimate. Originally, back in December, they were anticipating the home values would climb about 11%, and then last week they revised their forecast, for home prices that are set to spike 16.4%. Now, the thing about Zillow, and I am not a fan of Zillow. Okay, let's be
yeah.
clear. I'm not
They're
a
out
fan
there.
of some of but the thing
Yeah,
that Zillow has is they have access to data.
yeah,
They
Right.
have access to data. So when I see something like this, I think it's a reliable source
Yeah, it's come from somewhere. Yeah.
because it's not just some journalist that's pulling, information from here and information from there. It's a source that has its own data, has access to, they have listing data, they have buyer data, so on and so forth. So it's, I think it comes from a good source. That being said, the jury's out whether I don't know that 16.4%. I think we might see that soften. I think we might see that soften a little bit. I think it's going to be in the positive. I think that buyer demand and I don't think inventory is not going to catch up with buyer demand. So I think there's going to be appreciation for
Right.
sure. I don't think 16% I don't see 16%. We might see 8, 9%, maybe 10%, but I think 16% is aggressive, but we definitely will see appreciation. So
Yeah.
will it have downward pressure? Yes, but it's still like, not in the negative. We're
Right.
still going to be, buyers will still be paying more for a house in December than they would have in January. And I guess that's the message I think that's going to happen.
From pretty much the information I think that we have now, like that could be the only conclusion that we can come with at this point. Obviously, there's other factors involved. I mean, you know, uh, today to yesterday was all about Russia in our business. What was going to happen there? We're holding our breaths on that. Luckily, they're getting some information where they're taking some of the troops back. So that's going to alleviate hopefully that.
And
Uh,
who knows? You and I
you
could have
know,
a conversation in 2 weeks, and we'll recant this whole conversation. It'll be completely different.
Well, let's hope not. Let's hope it's all good. I believe me. I want to be all good with everything. And yeah, I think it's still a good time to go out purchase if that's what your plan is. I don't see anything in the near future that's going to change what's happening now. You know, prices are where they're at. I mean,
And
you got to
and
look around.
yeah, no, and on an ending note there, I would say, you know, don't time and people don't, but don't time your purchase unless you're an investor. You don't time the purchase on the interest rate. You don't time the purchase on the market.
Right.
You time
Correct.
it on your own personal situation.
Yeah. What's your
Always.
plan? What your
Always.
life plan is, and it's really part of your life plan. It's your shelter. It's your housing.
Yep.
Is it an investment? Yes. Is it other things? Yes. But is it what you're going to walk through the door in every day and rest your head in? And is it what you're going to walk out the door the next day with every day for who knows how long?
Right.
And that's the important piece of it. However you get there, as long as it's within your means, then that really should be what is the driving factor on your purchase.
And shelter to like a whole nother level because, as inflation rises, and we talked about this yesterday, as the inflation kind of gets a little bit scary,
Mhm.
what better way to hedge against inflation than to lock in on a fixed rate mortgage, whether it be a 30-year, a 15-year, 20-year, whatever, but on
Yep.
a fixed rate mortgage, a predictable mortgage payment, it insulates you. It
Right.
insulates you in the sense that, okay, so, this is the number that I have to come up with for every month. It doesn't
Mhm.
matter the price of I mean, yes, it matters the price of gas and then, in terms of your own personal household economy,
Yeah.
but in terms of your shelter, you don't have to worry about a landlord deciding to sell the property next year or the landlord saying, "Oh, well, the market went up, so now," which we've seen, "Oh, the rent was 1,800. I'm gonna jack your rent up to 2,200 or 2,000 or whatever."
Right.
Um, it doesn't, it's the best way to insulate yourself, against what's happening in that arena, is getting into your own home. So, all
Can
good
I,
stuff.
yeah, can I put one more plug in because we had talked
Yeah,
about
yeah,
this, and
yeah.
I think you were excited about it, and I think we kind of got lost in it with the down payments. But it was the approved to move that we had talked about.
Yes, yes.
And
Thank you
if
for
you
bringing that
just,
up.
I know, real quick though,
Yep.
but just explain what that means is when you're going to apply with a reputable person, whether it's with a referral from Jen or somebody down the street, you want to find somebody that's reputable. I've been doing this for 25 years. You want to find out somebody that's going to have some knowledge, communicate well with you, and really take you from the process from the beginning to the end. There's some places are great at it. There's some places that are not so great at it. But you really want to make sure it's something that's going to guide you through this process, because it can be pretty easy, but it can be pretty. There's going to be some bumps in the road, perhaps down the road. But that being said, we talked about a lot of buyers being out there, being competitive. I think you mentioned open house was like 20 people the other day, or 22.
Yes.
And part of the process for applying is what they call a pre-approval letter, which is somebody, a loan officer like myself, will take a look at your credit, take a look at your information on income, take a look at what your assets are, get you a plan of a program, and then get you what they call a pre-approval letter. So, okay, up to $500,000 with 5% down, you're pre-approved. What Embrace is doing is we can take that an extra step and take that pre-approval that I have, send it into our underwriting department, which actually is a second set of eyes, and actually gives the permission to lend the money out to you and approve your loan. We can take that step, and you can go out and make an offer with that particular letter and stand yourself out above other buyers.
That's awesome.
It's almost like cash, because you are approved for your financing. So normally on a contract for a purchase, and you will agree with me on this, is you have two big dates on that. Well, maybe a couple more, two on my end. I apologize, but there might be a couple others there too. But on my end for the mortgage, there's a commitment date, which is what we're talking about, which is usually like a week before the closing, and then the closing date. However, if you go through this process now, you already have that commitment date in hand. So you're almost like a cash buyer. You still have to get an appraisal, etc. But it sets you apart from the other pre-approvals for sure, because now you're one date away from closing on that property. You just need an appraisal. We can do it quicker. I don't know if that's important nowadays. At one point it might have been, but if you've got somebody waiting to move with a new construction or whatever, they're waiting to get into their property to sell it. This process could be a lot quicker. This could be like a 2-week process, as long as we get an appraiser out there, maybe 3 weeks, but certainly not 30 to 45 days.
That's awesome.
So,
I'm
excited about the program. It really is
awesome.
Some folks, definitely.
Well, you are one of my go-to guys for certain, as you know.
Appreciate that, Jen, of course.
Because you
we've
definitely
known each other since we did the batting cages.
forever and a day. After we did those batting cages, I was sore for days. For days. I said, I am not a young kid anymore. What was I thinking?
Well, I was happy to connect with one, but your daughter did great. I was not.
Chloe is
the old days.
The
old days are gone for me.
She didn't get her athletic aptitude from mom. I will tell you that.
But she was really good. She was, yeah. Very
so
nice.
that was a lot of fun. Well, this was fun to hang out with you for a little bit, and I think this was really enjoyed the conversation. So you can hang on after I shut down here. We'll say goodbye offline here, but thank you so much for those that are watching after the stream here, and really appreciate you staying to the end here. If you have any questions whatsoever for myself or for John, please leave it in the comments below. We will absolutely get back to you. And as always, if you know anyone that is thinking of buying or selling a home in the next 6 to 12 months, please give me a call. I'm always appreciative and ready for your referrals.
And you do a great job. You do a great job. You've helped we've helped a few people kind of get in and been very appreciative. So you do a great job. Yeah, done a few, but you've always done a great job. Always.
Fantastic. All right. Well, have a good day.
All right. Thanks, Jen. I appreciate it.